In this short Killik Explains video, I want to take on the Sherlock Holmes Moriarty or Godzilla King Kong debate of finance, active versus passive, and give a quick snapshot on why, despite its recent growing popularity from a small base, passive investing isn't perfect. It has its place, but it needs to be balanced with what some people see as its exact opposite, active investment management. So, with no more ado, here's the basic choice, if you like, as an investor. Do you go for an active approach, which is where you and/or a fund manager and/or portfolio advisor select securities following a number of core investing rules, or do you simply say, I'm just going to track a basket of securities? And that basket of securities could be cut a number of ways in terms of what you're actually following. So there it is, active versus passive. And this splits investing sometimes down the middle. My conclusion is going to be that actually there's a place for both. It's more about when you use them, not whether you should choose one over the other. Okay, so fans of passive investing say, right, what you want to do is you want to adopt an approach which is simple. You're going to simply track an index of shares, for example, and therefore cheap, because the construction of the asset allocation strategy can be done by a computer program, if you like, in a very simple case. So you're not paying an active fund manager to do stock or security selection for you, and therefore, overall, you're going to be better off. True or not true? All depends, is my answer. Three things to watch out for. First of all, what actually is passive investing? And some people would say, with some good reason, it doesn't really exist as you might think it does. Secondly, it encourages buy high, sell low investing, the exact opposite of what you want to be doing as an investor, which is buying low and selling high. More about that in a moment. And thirdly, not all passive funds are created equal. So when you hear the arguments simple and cheap, be careful to look under the bonnet and just make sure that they hold true, because in quite a few cases these days they don't necessarily. Now, first of those arguments, is passive investing possible? What is passive investing? There's actually no such thing. To be a truly passive investor, you'd have to hold a basket of all the stocks in the universe, and that's actually not possible. So you are making stock selection decisions when you passively invest, as it's called, because what you're doing is saying, well, I will track the S&P 500, or I'll track the FTSE 100, or I'll track the Euro Stoxx 50, or MSCI emerging markets, or high yield bonds. In fact, you are making choices. And every time you make an investment choice, you are choosing not to put your money to work elsewhere. In other words, there's always an opportunity cost with whatever decision you make. And although active investing sounds like someone's doing more work, in actual fact, underlying any passive investment decision is a choice about which market you want to be in, how you want to get exposure to it, and so on and so forth. And actually, even if you pick an apparently simple method of following a market, like a tracker fund, there are still quite a few decisions to make before you find the right tool for the job. Now, are indices the answer? A lot of people say, well, the great thing about passive investing is there are all these indices out there, pre-constructed. All you've got to do is find something that follows one of them, and Bob's your uncle. Take away the headaches and the expense of active investment management. But here's a quote I quite like by the gloriously named Professor David Snowball from Mutual Fund Investor. Index funds represent portfolios of stocks. Think about, for example, the FTSE 100, selected by flawed, conflicted, and occasionally dunderheaded human beings. Little harsh. What he's saying there is, don't just think you can sit back, follow an index, and all your investment wishes will come true. Why not? Well, here are just three things to think about, and I want to focus on the last one in just a moment in a bit more detail, a reminder about what's going on there. First of all, you can get sector bias. Sometimes you think you're tracking a broad market, and actually the index you're looking at has a weighting towards a particular type of stock, whether that be financials or technology stocks, depending on when you go into the market, or utilities, whatever it happens to be. So a so-called broad index can actually give you a narrower exposure than you might be expecting. Number two is the, am I getting exposure to the local market problem? If you choose an American index, for example, is it packed with companies that actually generate big earning streams overseas? I'm not saying that's a problem, many companies do that, but does that truly give you exposure to the local market you're trying to get exposure to? And thirdly, many of the big indices or most of the big indices are market capitalization driven. That is to say, they choose their constituents on the basis of size and the importance the market gives to them. And here's why that is not always ideal. Just a reminder, the market capitalization floor, as I'm going to call it, market cap, very brief reminder, is basically number of shares times share price for a company. And that tends to mean that with an index, whether it be the S&P 500 or the FTSE 100 or wherever it happens to be, the high value firms float to the top and the lower value firms tend to sit down the bottom. In other words, the index will attribute greater worth, if you like, to existing successful firms than perhaps the ones that are coming up through the ranks. And there are those people who say that that's not an efficient way to allocate capital, because at the end of the day, there must be stuff down here which is cheaper, better value, perhaps faster growing than there is up here. So, it's true to say that contrarians rarely simply follow an index, and there's a good reason for that, which is that you're not going to get your capital allocated to the potentially most future, most profitable opportunities by simply doing so. You will be, in effect, buying high, buying big, buying existing popular firms, and sort of ignoring, to some extent, the smaller ones. And often, if you've got an index like the FTSE 100, which is only one part of the market, it's kind of worse than that, because the companies that are most expensive in the next index down get promoted up into it, and it kind of drops the cheap ones. So for a lot of people, indices are flawed in the way that they actually force you to kind of allocate capital. That's worth thinking about. Choose your index carefully. Now, does your tracker track? Another peculiarity you might think of, well, surely it does. I buy a tracker, I'm going to get the performance of the index. No better, no worse. Well, not even that, in fact, because there will be some fees with a tracker fund, even if they're lower than you get with active management, and that's going to sort of put some drag on the performance. It's going to tend to pull it below the level of the index. And also, of course, you get tracking error, and tracking error can push the performance of the tracker below or above. It's a bit of a nuisance, and it's simply where the person who's designed the tracker has taken a shortcut. So they've thought, actually, we're not going to follow all the shares in that index. That sounds a bit like too much like hard work. We'll just pick the key ones in the index and design the tracker to follow those. Well, as soon as you do that, you're not going to get the performance of the underlying index. And that's another feature to just watch out for. It's worth doing a bit of homework on. An extreme case of where these things are not simple either is there are funds around that offer twice the inverse performance of an index. And this is where things can go really off the rails in terms of, were you really expecting that? They use something called daily repricing. And this is what can happen. I'll just keep this fairly simple. It's kind of an extreme case, but it makes my point about, are you actually getting the performance you're expecting? Let's say you've got an index, there it is, that basically starts at 1,000, goes up by 10%, down by 20%, up by 10%, while on pure averages, plus 10 minus 20 plus 10 is 0. But if you constantly recalculate the value of the index, it's actually dropped 3.2%. Now you've got a thing that supposedly gives you twice the inverse performance, and there are ETFs around like that. So you might think, well, that's okay, up 10%, double it, and turn it on its head is down 20. Down 20 would be up 40. This is for the ETF itself, if you like, the tracking fund. Up 10 would be down 20. Now, in percentage terms, that still gets you to 0, but because you're doing this change every day or at the end of every session, 1,000 becomes 800, rises to 1,120, drops to 896, and gives you an overall drop for the product that's supposedly tracking the index of 10.4%. So the index has gone down 3.2%. Yeah, product that's supposed to be giving you twice the inverse performance has gone down even more. Hardly makes any sense to most people, and it gives you a rather odd looking performance graph, something like that, where there's the index and there's the tracker. So, okay, that's an extreme case. That's a sort of complicated example of a so-called passive fund, where it just goes to show that you may not get the performance you're expecting unless you know what you are expecting. And these are often also not cheap to boot. So, conclusion. Am I rubbishing passive funds? No, of course I'm not. In the right circumstances, and that's the key, they can be very useful. When the aim is pure exposure, So I want to be exposed to the American stock market, all right? And you've got an underlying index which is well structured, 500 companies, that's a decent number, representative number, and relatively efficient. So the mechanics of how those companies are chosen are well understood. Yeah, as a simple way of getting exposure, maybe a passive tracker like an exchange traded fund is the way to go. It can also deliver simple, they're called smart beta in the marketing jargon, strategies, sometimes at sensible cost. So there are people around, it's not a tip by the way, there are people around who like to follow the dogs of the Dow. They simply mechanically pick out the stocks in the Dow Jones offering the highest yield, and they keep making sure their portfolio contains those. Now, that is not a tip, but if that's a strategy you want to follow, which is purely mechanical, there are exchange traded funds out there that can deliver it mechanically. And it's probably going to be cheaper in a lot of cases than paying an active manager to do the same thing. But that's not to say that passive funds can get you everything you want. Active approaches, when you can screen managers who can manage risk and add value. Managing risk, that's the ability to protect your money in a downturn. That's something that passive funds are particularly bad at. That is valuable. When there's no appropriate underlying index or it's poorly structured, there are certain parts of the world, emerging markets for example, where it's quite difficult to get the exposure you want, or you think you've got it through a passive fund and actually you've ended up horribly exposed to banks or the wrong sector. And when market conditions are tough, as I mentioned, passive funds have no way to reduce losses. They just track the index on the way up and they track it on the way down too. There's no management of that difficult, volatile set of circumstances going on. So, in overall conclusion terms, I like to use both, all right? And the key is to know when to use which one. A lot of ground covered there, it's a big debate. Any questions to the usual place?